Good afternoon, ladies and gentlemen. Welcome to our financial results presentation for the year 2013. Over the last 12 months, Hugo Boss achieved solid top and bottom line results, delivering on the targets we had set ourselves. Mark Langer will later on analyze our financials in more detail in his part of the presentation. We worked intensively on the execution of our medium-term strategy with major progress in all areas, as I'll demonstrate in the first part of our presentation. Beyond this, we have identified some new key long-term focus areas for the group that I will touch on together with our outlook for the year 2014. Let's start with a brief summary of 2013. 2013 proved very challenging for the premium and luxury goods industry overall. In hindsight, the economic and industry-specific background was clearly worse than we had expected when we met here together 12 months ago. Of course, our group was not immune to the challenges posed by a recessionary environment in Europe, uncertainty surrounding the US budget and significantly lower industry growth in Asia compared to prior years, in particular mainland China. Considering these conditions, we can be satisfied with what we achieved. Adjusted for currency effects, Hugo Boss consolidated sales increased by 6%. As a result, group revenues amounted to more than 2.4 billion euros. This means we have more than doubled sales within a 10-year period. The operating result grew by 7% to the amount of 565 million euros, also obviously a new record mark. Apart from the good financial performance, implementation of important strategic measures shaped last year. For instance, we streamlined and sharpened our brand portfolio by integrating the previously independent luxury business under Boss Selection into the Boss core brand. Looking back, this was clearly the right decision. The move allowed us to upgrade our complete offering and to strengthen our competence in high-end tailoring. Implemented for the first time in the 2013 fall collection, sell-throughs of our Boss Tailored Luxury business have been consistently above the previous Boss Selection business since then. As a result, we do expect the importance of luxury to grow, supplementing our historical strength in the premium segment. Expanding our offering in the higher price brackets as well as focusing on the Boss brand has placed us in a pretty strong position to effectively present our product range in larger stores as well. That's why flagship stores in key metropolitan areas accounted for a considerable part of 2013 retail expansion at Hugo Boss. In total, we added a net of 170 locations to our universe, which amounts to 1,010 locations now. 9 openings in the most relevant global shopping destinations of the world meant we now operate 25 flagships around the world. Asia was the key region in this respect. Highlight openings included Shanghai, where we now have stores in both the Kerry Center project and the APM project, plus Tokyo, where our building on Omotesando is an architectural highlight in itself, and Hong Kong. Here we opened 2 new stores in the Central District at the very end of the year, as well as on Canton Road in January. The Central District store, located in the famous landmark complex, is split across 2 levels. Measuring slightly above 1,000 square meters in total, the ground floor is exclusively dedicated to Boss Women. An oversized screen fills an impressive staircase void, guiding the customers down to the lower level, where we showcase our menswear brands Boss and Hugo, as well as Hugo Women's Wear together. A prominent display of women's bags on the ground floor as well as shoes and accessories area of more than 100 square meters. On the lower level, underline the importance we continue to place on this product group, especially in the Asian hemisphere. At a total size of close to 600 square meters, the Canton Road store, on the other side of the town, is by no means less impressive. Situated right next to the soon-to-be-open store of an American consumer electronics giant, we are confident we are located at an absolute hotspot of Hong Kong's most frequented shopping destination. Flagships are beacons that shine far beyond local markets to shape global brand perception. While these locations are ideally suited to live and breathe our brand, it is equally important that our presentation at all other consumer touchpoints lives up to our standards as well. Especially with regard to our distribution in multi-brand environments, we have made important progress over the past 2 years. The takeover of more than 230 shop-in-shops from wholesale partners over the past 24 months, including 115 in 2013, has meant that the image of Hugo Boss has become far more coherent across different distribution channels. Going forward, we will continue to assume active management of Hugo Boss shop-in-shops operated by department store partners where this is financially attractive to us, and we believe that we are the better owners of the asset. While by no means all of our department store partners are willing to hand over responsibility, our representation in more than 5,000 wholesale doors indicates the size of this opportunity. In the short term, however, our clear focus will continue to be on maximizing productivity of the shops taken over most recently. As a result of the openings, takeovers, and comparable store sales growth, retail accounts for a significantly larger share of our business today compared to our initial expectation. Growing further from the 54% level in 2013, we will be comfortably above the 60% mark in 2015. And of course, we'll not stop there, so that our own retail will count for an even larger share of sales in the medium and long term. In 2010, as you remember, we launched the Project Drive to fundamentally change the group's strategic orientation and key operational processes. After a successful 2013, we can consider the most important building blocks implemented. We streamlined and sharpened our brand portfolio, as you've seen. We significantly upgraded and expanded our store universe. Brand presentation at wholesale has started to see a step change following the expansion of the concession business model. The group's retail competence is growing steadily, and we have further solidified our best-in-class position when it comes to the operational excellence. Finally, we've made progress in better balancing our regional exposure and steered Europe through a long recession very successfully. The proven key elements of our strategy will remain relevant also in the coming years. Of course, we'll never stand still. That's why we have defined some new initiatives and focus areas that will open another chapter in the Hugo Boss growth story. I'll present them in more detail when I return, but first of all, I'd like to hand over to Mark Langer, who will summarize the group's financial results development in 2013.
Thank you. Thank you, Klaus, and good afternoon also from my side. Let me start with the sales development by region. In 2013, group sales increased 6% year-on-year on a currency-adjusted basis. Currency translation effects had a negative impact on this development. In euro terms, thus in the reporting currency of the group, revenues were up 4%, reaching more than 2.4 billion euro. All global regions contributed to this growth. Europe was the strongest growth region for us, with sales increasing 7% in local currency. Within Europe, the UK and French market were especially strong, climbing with 14% and 13% excluding currency effects. Thanks to the ongoing business model transformation towards own retail, Spain grew at a high single-digit rate as well. Germany was up a solid 4%. While sales in Scandinavia remained stable as compared to the prior year, the Benelux market were the only ones in Europe where we were suffering declines, primarily as a result of a challenging market situation in wholesale. In the Americas, the 6% currency-adjusted revenue growth was mainly due to solid growth in the U.S. market. The U.S. as a single market was up 7% despite some weaker trends towards the end of the year. Central and South America grew at a double-digit rate, while the Canadian market declined, predominantly as a result of a tough wholesale trading environment. In Asia, group sales were 4% higher than the prior year, excluding currency effects. In China, the effect from new store openings more than offset a negative sales development in existing stores for an overall growth rate of 2%. Within the Greater China area, Hong Kong, and to a lesser extent Macau, performed visibly stronger than the mainland. The region's two other major markets, Australia and Japan, grew at a single-digit rate, underlying the operational improvements we have implemented over the past 2 years. In the fourth quarter, Europe stood out with a double-digit revenue increase as momentum gathered across the region. Growth in the Americas was supported by good wholesale sales, also benefiting from early deliveries of some spring merchandise. Finally, in Asia, trends remained broadly stable compared to earlier in the year. In line with our group strategy, retail continued to be the main engine of growth in 2013. On a full-year base, retail sales were up 18% on a currency-adjusted base. On a comparable store base, that means adjusting for the effects from retail expansion, sales were 2% higher, excluding currency movements. Traffic was a clear drag in this respect, while conversion rates and transaction values developed very positively. By region, Europe and the Americas grew above group average, whereas Asia remained in negative territory, despite a visible improvement over the course of the second half year. Within the retail channel, online continued to outperform, with revenues increasing by 26% on a full-year basis. As a result, online today accounts for around 5% of our own retail sales. Wholesale sales were down 6% after adjustment for currency effects. This primarily reflects a tough overall market situation both in Europe as well as in the US. But also in addition, the takeovers of stores and shop-in-shops previously run by franchisees or department store partners accounted for around 3 percentage points of sales decline. Short-term replenishment sales were stable, indicating solid underlying demand and also healthy inventory levels among our partners. Last but not least, our royalties business grew 2% against a tough prior year comparison base. While our largest single category, fragrances, remained stable, eyewear recorded robust double-digit increases. In the fourth quarter, wholesale sales increased 1%. Retail revenues were up 17%. The latter was supported by comp store sales growth of 3% in the quarter. The contribution from new space remained at double-digit levels, despite the anniversary of some larger takeovers from the prior year. Let's go into more detail on our retail expansion. In the full year of 2013, we expanded our own retail universe by net 170 locations to more than 1,000. 115 additions represent takeovers from shop-in-shops from department store partners. The most important project in this respect were Saks in the US and El Corte Inglés in Spain, from whom we took over 37 and 23 shops respectively. Truly new openings, and you've seen in Klaus' presentation some examples from Asia, came to 91. Obviously, these stores were much more important than the takeovers just mentioned from a floor space perspective, contributing about 80% of the overall square meter addition. 36 stores in shop-in-shops, the majority of which were located in Asia, were closed over the period of 2013. Before I discuss our profit and loss in more detail, let me briefly outline some adjustment and corrections we made to prior year figures. In addition to the first-time adoption of the revised IAS 19, changes primarily relate to the allocation of certain cost items to either cost of sales or operating expenses. Following the closer organizational integration of the product development and sourcing production processes commenced in 2012, design and pattern making related expenses are no longer treated as cost of sales. In addition, direct selling expenses such as sales-linked commissions are now reported as operating expenses as well. Vice versa, some technical development and sourcing related costs, so far included in operating expenses, are now allocated to cost of sales. In sum, the overall effect on prior year financial results is hence only minimal. Let's look into the performance in more detail. In 2013, the group's gross profit margin increased by 330 basis points to 64.9%. Three almost equally weighted drivers were behind this development. A positive distribution channel mix, owing to the above-average growth of the own retail channel with higher gross margin, the sharp reduction of markdowns as compared to the prior year, and the non-recurrence of inventory devaluation effects that had impacted gross margin in the prior year period. This is a reflection of significantly lower stock levels achieved over the course of 2013. In the fourth quarter, gross profit margin improved even stronger. In addition to the factors just mentioned, this reflects strict pricing discipline in a highly promotional market environment, in particular in the US market. The expansion of the group's own retail network was again the key factor influencing full-year operating expense development. Primarily as a result of new store openings and takeovers, which are usually margin dilutive in the first year of operation, selling and distribution expenses were 13% above the prior year's figure. Administration expenses, however, increased at a rate similar to group sales growth, demonstrating ongoing discipline in managing overhead costs. EBITDA before special items rose 7% year-on-year to 565 million euro. As the improvement in the gross profit margin more than offset higher operating expenses as a percentage of sales, the adjusted EBITDA margin increased by 70 basis points to 23.2%. Group EBIT increased by 6% to 456 million euro, negatively affected by higher depreciation expenditures following the step-up in retail investments. Turning to the non-operational items of the P&L, the group's net financial result remained broadly stable as compared to the prior year. A decrease in net interest expenses following the reduction of net debt was offset by more negative exchange rate effects. Supported by a further tax rate improvement, net income attributable to shareholders grew by 7% to 329 million euro, translating into an earning per share of 4.77 euro. Let's go in more detail on the segmental profitability development. The group's operating profit growth was driven by increases in Europe and the Americas. In Europe, segment profit development benefited from the comprehensive retail network expansion, lower rebates, and good inventory control. Higher selling and distribution expenses, however, led to a slight margin decline. Nonetheless, Europe remains the group's most profitable region. In the Americas, good progress in terms of further limiting markdowns in particular had a strong positive impact on regional profitability. As a result, the Americas further narrowed the margin gap versus the two other regions. Finally, the profitability in Asia Pacific remained at high levels. Lower markdowns and good inventory management helped to compensate higher overhead expenses. As a result, the region's operating margin remained stable despite the muted sales development in some of the region's key markets. Let us now turn to the balance sheet, where 2013 was another year of major progress. At 17.9% of last 12 months sales, the group's average trade net working capital position reached an all-time low at the end of the year. In particular, inventory management benefited from operational process and system improvements, enhancing the group's reactivity to market developments. At the end of the period, the year-on-year development of the different working capital items has quite obviously returned to more normalized levels, following extraordinary declines in prior year's quarters. Nonetheless, the overall position continues to be very healthy. Inventories are up 5%, reflecting past retail expansion, as well as our growth expectation for the coming month. The increase of receivables primarily relates to the expansion of the concession business model, where cash is collected by our department store partners, constituting a receivable initially. Cash collection from wholesale partners remains healthy, with improving day sales outstanding in most markets. Last but not least, trade payables were up 3%. 2013, we made unparalleled investments in the long-term growth potential of the brand. Capital expenditures increased a further 12% compared to the prior year level and reached 185 million euro. Accounting for more than 60% of the overall investment volume, own retail continues to be at the forefront of our activities. Costs for expansion, in particular in form of new flagship stores, as well as renovation, totaled at 130 million euro. The remainder primarily relates to the construction of our new flat-packed goods distribution center in Filderstadt, as well as IT investments. Despite the increase in capital expenditures, free cash flow improved to 230 million euro. The increase in group operating profit, as well as strict working capital discipline, drove this development. Together with the effect from the distribution center deconsolidation, this supported a further reduction of net debt to 57 million euro at the end of the financial year. In light of the company's strong financial position and a positive outlook for the coming year, we will continue following our profit-oriented dividend policy of paying out between 60 and 80% of consolidated net income. For the financial year 2013, we will propose paying a dividend of €3.34 per share. That's an increase of 7% compared to the year before, in line with the net income growth. The implied payout ratio, therefore, remains unchanged at 70%. I will now hand the floor back to Klaus, who will outline our key strategic initiatives going forward. Thank you.
Thank you, Mark. Our 2013 financial and balance sheet performance is a testament to the successful execution of our group strategy with regard to maximizing brand strength, building own retail, exploiting global growth opportunities, and perfecting operational excellence. While our overall strategy will not change, the fact that we have ticked a lot of boxes across the different pillars allows us now to set new priorities to secure long-term sustainable growth. Let me go through our plans for 2014 as well as some initiatives that will shape the group's future also beyond the year 2015. Hugo Boss enjoys strong consumer perception around the world, especially in menswear. Consumers place high trust in us and in our products. Our collections deliver on the promise of impeccable quality, superb craftsmanship, and modern designs season after season. Our industrial scale and flawless operational processes give us a lead over many others in the industry, allowing us to offer a price-value relationship that is second to none. We know that fashion is a very emotional project at the same time. Our customers do not only want to get dressed for their next day in the office, but they strive to express attitude, style, and a distinct way of life. For them, a brand is not a product with a name, but a promise. Individuality plays a much greater role today than before. This is particularly true for fashion, for men as well as for women. It's made to measure instead of the off-the-shelf suit. It's personal service rather than anonymous shopping. It's customized communication instead of mass marketing. It's about emotionalizing the sell. It's about emotionalizing the brand. Going forward, we will build even more strongly on our heritage, our unmistakable DNA, and the power of our brand to engage with customers, with end consumers around the world. The customer is boss. Women's wear gives us a great opportunity in this respect. In mid-2013, we appointed Jason Wu as new artistic director for Boss Women's Wear. Jason is one of the world's biggest design talents in the high-end women's fashion area. Having established his own label from scratch in only a few years, he's a go-to name in the elite circle of New York fashion designers. After a good half year with the company, it has become clear to us that Jason was very quick to understand the essence of Hugo Boss. His sense for quality and his love of detail are an ideal fit for the brand's values. Jason has quickly established the fusion of clear lines and precise cuts, referencing our menswear clothing heritage with sophisticated, highly feminine elements as an unmistakable signature of Boss women. In his first fall collection, this feminine interpretation of modern business shines through all styles. Our company's start at the New York Fashion Week was the perfect setting for its presentation, upgrading brand perception, establishing Boss credibility as a women fashion destination. Inspired by our headquarters, the fusion of architecture set the tone of the show, featuring a star-studded front row including Gwyneth Paltrow, Diane Kruger, Gerard Butler, and Benedict Cumberbatch. Our appearance clearly made a lot of waves and attracted the who's who of fashion editors. Based on unprecedented levels of press coverage and the overwhelmingly positive feedback, the Jason Wu effect we targeted has already materialized. Further fueled by this increasing consumer awareness, the visibility of women's wear is clearly growing among department store partners and in own retail. In wholesale, we enjoy strong shop-in-shop presentations at Selfridges, Galeries Lafayette, and Matsuya in Japan, just to name a few examples. Opened only recently, Boss Women was also significantly upgraded at Paris department store Printemps. And based on initial customer feedback on the fall collection, we certainly expect to win further floor space. In own retail, we have meaningfully expanded women's wear in all larger stores with a strong women's wear retail environment. In these stores, women's wear usually occupies up to 30% of space, either close to the entrance area or on a dedicated separate floor. In order to cater even more specifically to the needs of the female consumer, we've also modified our most recent store concept to bring more femininity to materials as well as the entire seating area. With the fall collection designed by Jason Wu, while the fall collection designed by Jason Wu will only be available in the stores from June onwards, we expected to achieve double-digit sales growth in women's wear this year, also fueled by a strong first half year. It is this confidence in our brand proposition that has driven our decision to allocate half of our 2014 communication budget to womenswear, with print and digital being the two most important media. Our womenswear activities will also add spice and emotion to our core menswear business. Here, BOSS will continue to stand for refined modern luxury, promising that the consumer will be impeccably dressed in every situation. In our communication, we will focus all our above-the-line activities on the BOSS core brand in order to send a very clear, globally consistent message. Media support for BOSS Green and BOSS Orange will be exclusively focused on in-store presentation. Hugo will be strictly communicated as a separate brand, underlining the distinct role it plays in our brand portfolio. The new campaign, shot on the Salt Flats in Utah, US, again very effectively expresses the brand's role as a fashion spearhead. Over the last couple of years, we have comprehensively geared the entire organization towards own retail as the leading distribution channel. The implementation of the Drive project has played a major role in this respect. As a result, Hugo Boss has become significantly more agile and flexible in serving our consumers in our own growing retail network. As the number of openings over the past few years demonstrates, we have been extremely successful in conquering white space through the rollout of new stores. We are committed to opening around another 50 stores this year. While this will mean a slight deceleration as compared to 2013, this expansion pace continues to be considerable for an organization such as the one Hugo Boss is entertaining. Given the sheer size of our network has reached, however, it is obvious that our focus will need to shift even more to driving additional productivity in existing space. In this context, we will work on different fronts in 2014 and beyond. Above all, it's the in-store experience that forges close ties with our final consumers, or breaks them forever. Our stores and our collections are in itself a promise of superior service and luxurious buying experience. We need to make sure that we live up to this promise and the expectations of our consumers. Excellent service resonates far beyond the single store visit. It turns customers into loyal clients, connecting them with the brand ideally forever. In 2014, we will continue to put great emphasis on ensuring globally consistent high store operation standards. In doing so, we will further facilitate the sharing of best practices between the different markets. Based on the result of structured consumer surveys initiated directly at the point of sale, as well as around 6,000 annual mystery shopping visits, we have an excellent base to define training needs and potential for service quality improvements. One such area is the use of mobile in-store technology to facilitate the entire payment process. For example, corresponding to the demands of our consumers, we are currently piloting a mobile cash desk solution in one of our stores. In addition to that, consumers clearly expect online and physical retailing to become two sides of the same coin. I would even go as far as saying that fewer and fewer consumers will make a difference between both worlds going forward as they experience brands through multiple channels anywhere, anytime. Online is here to stay, and we better use this fact to our entire advantage. In light of the strength of our operational processes, our success in building e-commerce, as well as the entire mindset of our organization embracing change, I do see Hugo Boss as ideally positioned to benefit from this important megatrend. In the past, we have had considerable success in both channels. Going forward, we'll drive omnichannel to make the whole more than the sum of its parts. But we will still have some work to do to get there. In the first step, we need to redefine our e-commerce offering this year. We'll break the barriers between commerce and content by marrying or by linking our online store with our hugoboss.com brand world. The creation of a holistic offering will seamlessly integrate editorial content, community offerings, and product. In the wake of this, we will evaluate our entire online and social media presence in order to effectively channel traffic to hugoboss.com. At the same time, we'll pave the way for closer integration of e-commerce and offline retail, addressing the challenges primarily related to existing organizational and technical barriers. Let's talk about myhugoboss.com. The rollout of this tool, myhugoboss.com, represents a first important step in precisely this direction. Creating one centralized customer account integrated with all brand touchpoints, physical, mobile, online, as well as social and digital media offerings, will offer our consumers a personalized service across all channels. In the future, she or he will be able to check online whether a particular product spotted in our e-commerce offering or twittered by one of our brand ambassadors is on stock in her or his favorite store location chosen as default. What still sounds a long way off will become reality step by step as we pilot myhugoboss.com in selected markets for further rollout in Europe later this year and at the beginning of 2015. This entire process will be facilitated by the further enhancement of key merchandise planning and merchandise management processes in order to drive additional efficiency and productivity out of our stores. The enablement of a true end-to-end solution will optimize sales and inventory planning through an integrated view on both. Upon full implementation, this tool will significantly enhance transparency of stock levels and merchandise flows to manage markdowns and returns more flexible and on a far more granular level compared to today. The potential uplift for full price sell-through and gross profit margin gains are certainly significant in the long term. However, the effect will unfold over time as the solution's global rollout will be carried out in phases until the end of 2015. Far more short-term, as you know, is the go-live of our new flat-packed goods distribution center in Filderstadt, Bonlanden. You may have seen it on your way here to Metzingen on the right side, which will replace two technologically outdated facilities. Around 6 weeks ago, we successfully completed all tests so that the migration process is fully underway and expected to be completed by the end of June. The advantages of the new setup are clearly cut. On the one hand, the distribution center will cater to the expected growth in our business and significantly improve the speed and quality with which we can replenish our European-owned retail universe with floor-ready merchandise. Going forward, we will supply the whole of Europe within 24 hours on a daily basis. On the other hand, we also project the center to support efficiency gains through more comprehensive and state-of-the-art automation and close upstream integration with sourcing and global transportation processes. Let's talk about our business across the different regions. Before we come to the financial outlook, would like to inform you about our expectation by region. In Europe, we have seen very encouraging trends over the course of the second half of 2013. Now that the region has overcome recession, at least for us, sentiment is improving across customers and retail partners. While we are certainly not back to the boom levels of before, we look at Europe as a source of good growth also in 2014. This is true for core markets such as UK, Germany and France, but also Southern European markets such as Spain and Portugal. Our strategy is two-pronged. On the one hand, we will grow our network of own stores, strengthening homogeneity, or let's say a homogeneous approach and the quality of brand presentation. We are raising our appeal both for local consumers as well as for the growing number of non-Europeans who visit Europe as tourists. On the other hand, we will work towards further lifting brand presence in multi-brand environments by intensifying cooperation with wholesale partners and expanding fully controlled space. In this context, we have agreed with our most important department store partner, Pick & Kloppenburg, to establish more than 150 shop-in-shops in Germany, Austria and several Eastern European markets in the second half of 2014 as a first step. While Pick & Kloppenburg will continue to manage these point of sales, the implementation for our furniture will visibly lift the quality and in-store presentation. Let's talk about the American continent. It's currently going through a more difficult period of subdued growth coupled with extensive promotional activity. That's what we see, dampening also our performance after years of outstanding growth. Going forward, our position is very clear. We are not willing to sacrifice margin and consumer trust for short-term sales objectives. We are convinced it's right for brand equity as well as financial results. There shouldn't be reason for an overly pessimistic view with regard to the Americas business. In light of an overall favorable macroeconomic backdrop, all pieces are in place for the American premium and luxury apparel market to regain momentum soon. We are prepared to capitalize on this on the back of our proven strength in menswear clothing, where Hugo Boss stands for sharp and modern fit. Building on the reputation Jason Wu enjoys in the US, we are also confident women's wear can develop into a relevant growth driver for us. Based on initial collection feedback, our offering resonates very well with wholesale partners. In own retail, the visibility of women's wear has increased anyway, as a visit to our Columbus Circle flagship store in New York is just one example will demonstrate. Let's talk about Asia. We intensively work on re-accelerating trends in Asia. Some might argue that the group's relatively small emerging market exposure is an advantage in times of shaky growth and tumbling currencies in many markets falling under this definition. We do see this differently. Based on the strength of our business model and the global recognition of our brand, Hugo Boss should generate a much bigger share of its business outside of its development countries. China remains an obvious opportunity in this respect. Nothing has changed. Investing in the quality of our retail presence and brand perception remain cornerstones of our regional strategy for long. From Shanghai to Hong Kong, we now have a flagship store portfolio demonstrating the full strength of the brand in a very visible way. Our determination and commitment, also underlined by 2 large-scale fashion shows over the past 24 months, has opened up additional doors for growth. Only a few weeks ago, for example, we succeeded in a highly competitive tender process to secure a key location at Hong Kong Airport Terminal 1, something barely possible only a while ago. We know there's more work to do. It's not going to be easy. We are working through our franchise legacy store by store, as we told you already a couple of years ago, with another around 20 locations to be renovated, relocated, or closed this year. At the same time, we are concentrating on building retail excellence with the ultimate goal of creating a world-class consumer service experience across our network. In 2014, we will in particular emphasize our unmatched competence in suiting and strong European heritage to exploit the full potential of this rapidly developing market segment. Starting in April, we will tour key Chinese and Asian cities with a mobile exhibition called Art of Tailoring. Consumers will have the opportunity to experience firsthand the craftsmanship and sartorial artistry that go into a Hugo Boss suit. Equally relevant, the exhibition provides us with a platform to showcase the Boss brand in its entirety, shaping brand attitude on a very emotional level. Made to measure will be another important concept in this respect. Starting in Shanghai, Hong Kong and Beijing, we are now about to establish our most upmarket suit offering also in Asia. Representing the fusion of artisanal love of detail with German engineering skills, Made to measure stands for highest wearing comfort and the absolute high end of the Boss brand. Its launch will help us satisfying the demand of an increasingly sophisticated and growing consumer base, for whom style, quality and uniqueness drive the final purchasing decision. Of even greater relevance will be the important effect that is going to spill over to the brand as a whole. Let's come to the outlook for 2014. Tying all comments together, we expect growth to accelerate in 2014. Group sales will rise at a high single-digit rate on a currency-adjusted base, thereby outperforming the overall economy as well as the luxury goods industry. All regions are forecasted to contribute to the overall group sales increase. By distribution channel, retail will grow at a double-digit rate, driven by comp store sales increases and around 50 new store openings. Wholesale sales are expected to remain broadly stable on a currency-adjusted basis. Based on pre-order development, we expect performance in this distribution channel to pick up after a more difficult first quarter. Gross margin is projected to increase primarily as a result of a positive distribution channel mix. In addition to that, we remain confident in our ability to offset rising labor costs, expenses through efficiency gains in our production and sourcing activities. Operating expenses will increase mainly on account of the ongoing own retail expansion. Moreover, we will raise marketing expenditures to a level of more than 6% of group sales. Logistics expenses will grow due to the new flat-packed goods distribution center going into operation in June 2013. This impact will be weighed towards the first half year, reflecting the migration of existing locations. As a result, we forecast EBITDA before special items to grow similar to sales at a high single-digit rate in 2014. Therefore, EBITDA margin is projected to remain on approximately the prior year level. Retail expansion and renovation will continue to be at the forefront of our investment activity. Nonetheless, capital expenditures will decline to a level in between 110 and 130 million euros. This will be mainly consequence of the non-recurrence of prior year infrastructure and flagship store investments. On the back of good profit growth and tight working capital management, we forecast further net debt reductions and the achievement of a positive financial position by the end of this year. Ladies and gentlemen, 2013 has been a year of solid financial performance and good strategic progress. In 2014, we will focus on further exploiting our brand potential in areas we think are greatly underrepresented. We will drive retail to offer consumers an outstanding experience wherever they get in touch with us. And for sure, we will tackle the challenges in Asia and address the more demanding market environment in the Americas. However, focus on short-term opportunities will not distract us from building the business for the long term. We see great potential in further elevating the brand, in creating desirability and emotions that are key to build long-term relationships with our final consumers. We see enormous opportunities in tearing down the walls that still separate online and offline, to offer consumers a seamless brand world across all distribution channels. And finally, we are convinced that our pursuit of retail excellence will go hand in hand with operational and process improvements, yielding very attractive financial results as we have proven in the past. Over the coming months and quarters, we'll report back on how we fill these focus areas with life, opening up the next chapter of the success story that Hugo Boss represents today. We're now happy to take your questions. Thank you for your attention.
Yeah, thank you very much. And I would just like to remind you that there are also people following us over the webcast. So please, when you ask a question, make sure that you state your name and your institution. The first question comes from Matthias Eifert.
Yes, hi, Matthias Eifert from MainFirst. First question would be on your 2014 guidance. Have you factored in additional shop-in-shop takeovers from some of your retail partners, as you still have several hundred stores managed by third parties? And if not, did you factor that in on the way to your 2015 goal of 3 billion of sales, which you also reiterated today? And the same question, have you factored in anything for Russia, for the franchise stores there? And the second part I would like you to comment on is about your dividend payout ratio. You kept it stable, although your financial position has improved so much. What is your thinking behind there? Can we expect it to move closer to the 80%, that given that you probably soon be net cash positive? Thank you.
Yeah, I think we're in good company when you look at our balance sheet development in terms of indebtedness. I think it's not unusual for Hugo Boss in the luxury universe also to join the group of cash positive companies. And I think one element that you also have seen will become more relevant. It's not only financial indebtedness that plays a role, but also lease obligations that we carry with a network with more than 1,000 stores. So this form of financial obligation is clearly already much larger than what we carry as financial debt. So we feel very comfortable. It gives us a sound financial base also in times which we do not expect for the year 2014, but from a difficult market situation. And it gives us room for investments that we highlighted. If you adjust 2013 actual figures for the still around 30 million investment for the flat good, packed goods, and the clearly higher number of organic openings, 91 versus 50 guided for this year, we do expect also for the years to come between 110 and 130 million investments, where the share of renovation becomes more relevant. We clearly highlighted for 2013, and the same was true for 2012, that takeovers from concession spaces in Europe and Americas have played a major role, also explaining the decline in our wholesale development in the last year. There will be smaller concession takeovers also in 2014. There's one deal that we expect to close in this year, probably in Australia, but they're significantly smaller than anything that we have recorded over the last 2 years. So it will not play a significant building block role to achieve the 2015 targets. So they are smaller takeovers, not relevant in terms of the overall high single-digit growth objective for this year, that we will report back on when they become effective, but they do not play a major role, whether they're included or not, to hit on our 3 billion target. On Russia, we are following the situation very closely. You know that we have exposure to this market in a more direct way than in the past. We do operate a significant flagship store in Moscow now ourselves via our Russian subsidiary, so we are much closer, more reactive to the market. We continue to believe in the potential in emerging markets despite the current developments that we also follow on the exchange rate developments in emerging market currency, whether it's the euro. However, given the size of the market, our exposure to own retail, we don't see any risk to our financial plans in 2014 from the current development.
Next question from Jürgen Kolb.
Thank you, Jürgen Kolb from Kepler Cheuvreux. 3 questions. First of all, on the number of new stores that you're opening this year, I think 50 you mentioned. How many of those are the true flagship stores in this set of numbers? And then going forward here a little bit, as you're planning to increase that share of on retail above 60%, is that a run rate we should also expect going forward next 2, 3, 4 years, maybe 50 new stores? Secondly, also in this respect, the made to measure is, I think, now in 15 of your flagship stores included. The rollout, is that going to be to all 25 stores already this year, or will it take a little bit longer? Second part, the deal with P&C. Mr. Lars, you mentioned that. Could you explain that a little bit deeper? I think I haven't fully understand what this specifically is. Is that a concession business? Is that more a shop-in-shop business model? Is that completely new, or what is that behind it? And then lastly, on the omni-channel idea, how far would you say are you in terms of logistics, in terms of systems, in terms of the ability for the consumer to buy online, return it in the store? How far are the systems up to date from that perspective, and when do you think you can have it to that level where you think it's necessary? Thanks.
Let me start with this omni-channel question. Omni-channel means you have one store and one stock centralized available, and this is something which we are going to own latest end of 2015, beginning of 2016. That's important. We know that there's one big additional business coming. It's this click and collect. So you buy online and collect at your most favorite store, be it in the neighborhood or wherever you prefer to shop. This is something we definitely need to get ready for, but it means we need to work with one centralized stock, which will become more and more reality with the inauguration of the new flat pack warehouse facility not so far away from here. But it's linked to, if you like, integrating all the services currently provided by a service provider into our IT universe. We are already working on this. We think we will be one of the first companies with own stores and an existing e-commerce business able to create a full integration. But as we mentioned, it will take 2014 as well as 2015 for the completion of this very important project. The P&C deal is a deal which is not so new to us in terms of shop-in-shop presence. What is new is that we informed our wholesale partners that BOSS will be the preferred retail brand in our portfolio, which means whoever would like to trade BOSS either has to give us the management of the space, certain minimum space, with own furniture, own staff, and own merchandise, or if for whatever kind of reason they prefer to be the better retailer, they need to significantly invest into a very different presence of the brand in the upper floors of their department stores, where you can see the exclusive and luxury brands positioned. So BOSS will disappear from the category business completely in 2016. This role will be replaced by Hugo. Hugo will take this very important role, and we are going to do what we are working on already for a while, making sure that this very inconsistent presentation of BOSS around the globe, including the price positioning, will down the road not completely disappear, but be decreased. That's the deal with our most important partner. We are working on similar deals, as you know, and for that reason, we believe that it's right for the brand, and it will certainly give, especially to the rising group of consumers coming from abroad, a much more consistent picture about the brand than what they take today. Your question with regard to the opening flagship stores, we do have a very important opening in Osaka in the second half of 2014. It's as important as Tokyo. And we will have another very important opening for men and women with dedicated space for women in Rome on Via Fatini, where we will be for the first time present with a very visible location. Made to measure will go into the flagships. It's something which is linked to that, because we whenever we open important new stores, we also see a different customer entering our stores. We saw this right before Christmas in Stuttgart. We saw it right before Christmas in Berlin on Kurfürstendamm. We see it in Hong Kong. We see it in Tokyo. So whenever we put our name, and that's the interesting thing in the entire strategy, put our name into the right streets, coupled with the right management and a different product assortment, we all of a sudden discover customers we haven't seen before.
Next question comes from Volker.
Yes, hello, Volker Boste, Baader Bank. I have 4 questions. First, on the retail segment, you mentioned 50 store openings. Could you split that down by regions, please? Second, on your wholesale business, how do you see the pre-order situation and how do you see the financial situation of your retail partners? So, did you list out any retail partners in order to avoid potential write-downs of receivables going forward? And third question is on your warehouse. Could you please quantify the full year benefit from the logistical change here on a full year basis in euro terms? Just a rough idea on that. And finally, on your online business, your service partner, Netrada, was taken over by Arvato. So how does that impact your financial conditions with the partner? So is it coming with higher costs or is it same situation as before? Thanks.
Arvato stepped into the deal, so there's no difference.
Okay.
And we are looking forward to see how the partnership unfolds. But it was reassuring to us that Netrada was kind of integrated into the Arvato infrastructure in order to continue to develop a growing business for us. Coming to the wholesale question, how do you see insolvencies? Yes, we continue to see customers disappearing, but if you look into the ever decreasing number of daily sales outstanding, we have a very strong position. So compared to where we were a couple of years ago, it's pretty impressive to see how appreciated the brand is for all the partners who survive. And yes, we see partners who are unable to survive because of family reasons, because of financial reasons. But if I simply look into the business with our existing strong partners, and part of the wholesale decrease is due to the takeovers we organized deliberately. If I look into our market share with the important partners in Europe as well as in the US, we continue to grow market share, and what we have experienced for the fall-winter 2014 order intake looks very reassuring.
Yeah, I think your last question was on the opening distribution by markets. It's a bit different. We have not full visibility on all these contracts because some we're still in negotiation phase, but we feel comfortable with the number of opportunities that we are pursuing right now, plus already signed deals, that we will hit a full year numbers of about 50. I would expect a very similar distribution what you've seen over the last 2 years. that the majority of openings will be again in the European market, not one particular market to stand out. But we continue to see in our home market, especially with the shift from wholesale to retail, also on the white space expansion opportunities in Europe, with a smaller share equally distributed between Asia Pacific and the Americas. Say it again. Yes. Well, no specific or concrete answer to that. First of all, it's important to understand that we are now in the middle of a phase where we have double spendings due to the parallel operation of both setups. We do expect, with the full operational start of the new facility, that we will see significant decreases in handling costs per unit. We are still a bit shy to quantify them and fully expect it. It depends how quickly we are able to ramp up the operation. But I'm confident that we'll see as a logistic expenses related to flat goods Europe, so it's not the global logistic expenses clearly, but European flat good cost per piece, that we see at least a double-digit decrease in handling cost per piece with the new setup versus the previous setup. You will see a phase in, phase out. The full year where we see the impact in our European P&L from the operation will be the year 2015. And I would assume latest in the second half of this year, we can give a more precise figure on the improvement in handling cost per piece, but it's still a bit early to quantify today.
I think there was another question by Andreas Innes.
Andreas Innes, Exane BNP Paribas. I have 3 questions. The first one, compared to the last time we met in Hong Kong 3 months ago, has your confidence level changed towards the full year 14 growth rate and for your 2015 sales target? In this respect, for which region are you most upbeat in the short term? For which region are you more cautious? And that's my first question. The second question on women's wear, you allocate much more shelf space to women's wear. Your marketing will increase significantly. You guide for double-digit growth in 2014. What kind of sales potential do you see for BOSS Woman in the next 5 years? And my third question, you have worked on your pricing architecture in Europe, in particular. The peak deal certainly will contribute to that as well. But what kind of progress have you overall made in terms of pricing in Europe, and what is the response by your wholesale accounts and the customers? Thank you.
Yeah, 3 very interesting questions, and all valid. I'd like to start with the pricing question. If you look into the segment profitability Mark presented a couple of minutes ago, you see that if we look into the Asian hemisphere, we only need not even 1/3 of net sales to more or less reach the same profitability as we are reaching in Europe. What does it say? It doesn't say that we are overpriced in Asia. It means that raising prices, raising desirability, and raising product content makes sense. And due to the fact that we are only in Germany and only in the US, due to the famous category business, we followed very long and I would say to a certain degree, where we kind of start with entry price positionings. And what we mentioned to you with regard to the BOSS strategy, we will definitely work on bringing the brand from a price perspective to the level where it belongs, number 1. And number 2, to make sure that the inconsistency we not only see in between China and Germany, but also inside Europe, is going to be reduced. So that's our first answer. It's a touchy process. We do this with a lot of care and with a lot of sensitivity, because we are not convinced that simply raising prices without adding content makes sense. We also have to deliver a different shopping and customer experience. All this is happening. For that reason, we are departing category departments from major department store players with BOSS, and move into the exclusive or luxury departments on the upper floors with our most important global brand called Boss, and that's the way we think we are going to handle this. But as you can see, we are careful. We are careful with regard to the communication, and we are also careful with regard to what kind of steps we are taking. But there's no way out of simply acknowledging that the current situation in between some European markets like Germany and China has to be addressed, especially with the rising number of Chinese consumers visiting Europe. So that's, I would say, the first answer to your last question. The women's sales potential, very difficult to predict as a concrete number. Today we are at 250. We see already very important momentum going on due to what we have done before Jason, but now with Jason. If you simply look into the online editorial feedback on the show, it's more than twice than what we got from the show in Shanghai, and the show in Shanghai already was very successful. If you simply look into the viewers of the live stream during the show, but also after the show, it's 4 times what we have seen in Shanghai. If we look into our own store, women's wear sellout performance, it's double-digit up against last year. And if we look into our order book with our most important wholesale partners, the same situation. So there is a very important room for reasonable, positive imagination, and I would say we only started to tap the potential which is sitting in front of us. The question with regard to how do we see the regions to develop. First of all, it's great to see that our most important region, Europe, with a 60% share, is doing fine. Started to do fine already in 2013, up from the second half. Key markets came back. Germany was pretty strong throughout the entire year. France came back in May, and UK gave us a very strong result throughout the entire year 2013. This continues to confirm, so we don't see any change with regard to that. We even see countries which were difficult in Europe for the first half of the year coming back stronger than expected. The US is kind of soft right now. We have seen this. We see the first positive signs that business is gaining some momentum, but the business has been impacted by what happened in October of last year, and we expect this to come back step by step in 2014. Asia, Australia very strong, Japan good momentum, mainland China very difficult to predict. January was strong, February was, due to the Chinese New Year, very challenging, and we see some kind of business coming back in March. There's one thing which hasn't changed, it's traffic. Traffic is still down. We see a lot of insecurity with consumers due to the fact that the government policy is becoming rather stricter than softer, and we are extremely careful with regard to a mainland China prediction in terms of uptick of the business. But we also have to say it's not only mainland China consumer sentiment which is helping us to take advantage of Chinese. We also have to take into consideration that the Chinese are traveling more and more, and the business we do in China or with Chinese consumers outside China is considerable, and for that reason we think that investing into the most important cities makes a lot of sense, not only for getting ready for the uptick of the entire momentum in China, it will come, but also for what we currently see in Europe as well as in the Americas.
Thank you.
Next question from John Guy.
Yes, thank you. It's John Guy from Berenberg. 3 questions, please. First of all, following on from the women's wear comments that you just made, when you think about the incremental spend that you're going to have to put into the A&P, when you think about leveraging and increasing your size and scale in accessories and bags and other areas within the women's segment, vis-à-vis your margin across men's, women's wear, etc. To what point does that start to become accretive when you have size and scale given your current women's wear business, and for how long do you think it will be dilutive to the overall margin? That's my first question. Second question with regards to full price sell-through. If you think about an industry benchmark around about, say, 70%, where are you today relative to that? And could you maybe give us some numbers around how markdown has effectively improved over the course of the last 5 years? Finally, with regards to Boss Black and Selection, can you give us a percentage of sales target by 2016, and what rate of growth do you expect within the luxury segment relative to the premium segment? I think in your presentation you talked about the luxury segment growing faster than the premium segment. Thank you.
Let me take the first question on women's wear profitability. As you know, we have changed segmental reporting, I think 3 or 4 years ago when we moved to by geographic segments. So we do not disclose profitability by brand lines or gender going forward. However, we have stated on different occasions again and again that we are, with the size of our women's wear business today, already at the stage that we run an industrial scale business also in women's wear. With more than 250 million euro in sales, we are at the same size or even bigger than many other players which are purely and only depending on a women's wear apparel business. So as we operate today, when it comes to gross margin, it's I think the important part where incremental business impact becomes relevant. Our women's wear business is as profitable as our menswear business. So any further development into this business will be as accretive to our profitability as further growth will be in menswear. Your second question was on markdown, the impact on further improvement in markdown management over the last years. It's a question how far you want to go back. If you look just at the last 3 fiscal years, 2011, 12, and 13, it was especially in the years 2011 and 2013 where we stated clear progress from a reduced markdown management, in particular from retail. As I said, out of the 350 basis points improvement last year, about equally weighted markdown management, in particular in retail, played a role. We had a similar sized impact in 2011. However, it was more flattish development in 2012 as we highlighted last year. So taking both factors together, it's a sizable improvement just over the last 3 years from better sell-through at higher at full price. And I think we highlighted also, for those of you who recall from our meeting in Hong Kong, yes, we continue to focus on increasing the share of full price sales in our stores, given that we have a very effective factory outlet network to sell unsold factors and not to be too aggressive in our own retail network. But we see now the focus rather in driving traffic, driving conversion rates, rather than expecting further significant step up in full price sell-through. I think the last question was about growth expectation. If you recall from our November presentation, we gave you some insights. What was the impact development of share of luxury price points in our Boss menswear development prior and post the Selection integration? It was just a comparison over about a year, but the tendency is very stable. We have seen the relative share of luxury price points almost more than doubled as a percentage of sales. I do not expect a further similar improvement to that, but what Klaus described as what we are doing now with Peek and Cloppenburg, especially in our core brand in Boss, we do expect a further improvement in the relative share of luxury price points, in particular in our Boss offering.
Thank you.
Next question from Rogerio Fujimori.
Mr. Lahr, I was wondering if you could elaborate on your assessment of the U.S. premium clothing market. I understood that you expect the market to come back step by step, but are you planning more conservatively for 2014? My second question about China. You've mentioned that traffic remains weak, but I was just wondering about how the other elements in terms of conversion rates and transaction size if you have seen any change in trends more recently. And then my last question is on your guidance for 2014 of high single-digit growth. Should we think about, do you expect that growth to be relatively balanced when we think about first half and second half? Thank you.
The first question is with regard to the U.S. As we mentioned, we had a very strong 2013 till the budget freeze, and then we saw traffic patterns changing in a very important way in the overall market, including the malls. It has slightly improved, but it's not yet back to what we saw before. So we're a little more careful with regard to the U.S. business than we would have been without this special event in October 2013. But based on what we know, based on pre-order activity, but also based on our own retail activity, we think that the situation will come back to some kind of normality during second half. China is a mixed bag. So as I mentioned, the month of January, very strong, very encouraging. A very encouraging business with the Chinese, not buying in China, but buying outside. This will certainly be something which will be high on our radar. But also here we are at least seeing that we are able to compensate for reduced traffic by higher transaction value, by more important conversion rates, and giving customer service to customers we didn't know even before, because we were more or less organized via franchise stores. So we are starting from a very wide page based on what we are currently doing compared to the situation before. The guidance I would like to give back to Mark.
Well, first of all, we do the guidance on a full year base. I understand your interest in the quarterly development. Just a couple of information to that. One is clearly, you know, from the past that especially the first and the third quarter, historically we are strong wholesale quarters for Hugo Boss. This has changed, and especially in the first half year of 2014, where the takeover of concession spaces at Saks and accordingly are not part of the base. We do two effects. We'll see the continuous negative impact on wholesale, plus we see the dilutive impact in year one from these takeovers. Also, we highlighted that we have seen an increase in confidence in order behavior from our wholesale partners when it comes to fall/winter performance. There was a more muted order behavior from our wholesale partners when it relates to spring/summer. So taking these factors together, I would expect a slightly stronger development for the full year in the second half, or starting with the second quarter, whereas the first quarter will be clearly below our full year guidance without giving already today a Q1 financial guidance to you. Thank you.
And sorry, just one confirmation on your marketing guidance. We should expect that spending to be more like first half skewed, given all the initiatives in womenswear?
No, I think it's a very important point for those of you who missed our important message also from Hong Kong. We guided the market to expect around 100 basis points higher marketing spendings compared. Now you have actual numbers, and we clearly highlighted that higher marketing spendings in 2014 will be, all other things equal, will have a negative impact on profitability progress. But I expect this development to be relatively equally spread about the year. You remember last year we had our big fashion show in Shanghai in the second quarter. Now we had the major event in New York in the first quarter. So I would expect marketing spendings to be rather equally split. But I think the important message is for the full year 2014, we expect about 100 basis points higher marketing spendings for the group.
One question from Philipp Frey.
Philipp Frey, Warburg. Can you elaborate a bit on the development basically of your operating cost base in retail? If I calculated it correctly, actually you've done a pretty good job in the last year with, well, basically the OTC-based retail like-for-like growth being pretty flattish and substantially increasing your margin. Can you shed some light on that and under the dilutive impact actually of the online growth on your retail margins in general?
Well, there are three factors, and when you look into retail cost development, if you compare to retail top line development, first of all, in markets, in China in particular, where we are faced with negative like-for-likes, there were limited means to the group to adjust cost base in an equally base. We have high quality expectation standard when it comes to staffing levels and quality of service. Rental contracts, at least to a certain minimum, are fixed. So in this situation, it's very difficult for us to maintain retail expenses as a percentage of sales. However, on the other hand, we have seen more positive, even accelerating like-for-like trends in other parts of the world, in Europe and Asia, Europe and Americas, where we're able to leverage the cost base and drive retail expenses as a percentage of sales down. Further important factor that we have reiterated time and time again is that whenever we take over significant spaces from our former wholesale partners, be it Saks, be it Corning Glass, we take over a business that in all cases is significantly below the Hugo Boss profitability when it comes to the acquired business. So in these cases, we are faced with the situation that the increase in profitability, in margin, is in the first year typically outweighed by the increase in fixed cost. It's profitable business, but not as profitable as our existing business with above 23% margin. However, what we have demonstrated over the last couple of years is that we are able to drive sales density in these spaces once we are the owner and operator of these spaces beyond the level from our former partners. Thus, in other words, it's a very attractive business case as we go into the year 2 and 3 of the operation. So the observation is right. The year 2013 has been a challenging year for us with around 3% slightly less than 3% like-for-like growth to manage further profitability improvement in our retail business. I think it underscores other elements in fixed cost control, but also pricing, margin control, and inventory management that we have been able to drive group's profitability another 70 basis points despite this very challenging retail environment.
Thank you. Are there any further questions? No, obviously there aren't. And thank you very much for making your way to Metzingen and listening to our conference over the internet. We'll come back on May 7 with our first quarter reporting. Have a good day.